All right. Good morning, everybody. So we made it through the CPI and the PPI. Right now, the market's going to be looking for anything that will adjust the Fed's dot plot statistics or their dot plot values to force them to raise again. So anything that could do that is going to be seen as a threat, and the market will um, try to it'll try to price in a rate hike if that happens. So let's bring over the usual screen. We got a lot of Fed speakers next week. You can see on Monday, like they all want to get out there. Don't be surprised if one of these does the full Ginsburg, right? And that's just an old school phrase where they go to every one of the major news circuits on Sunday and hit them all on a single day. Obviously, that's a lot of work. It's not something that we see all the time, but it's not some unicorn that like rarely happens. It seems like it's happening maybe a little more frequently than it used to. And it generally happens when they're really trying to push a narrative. When you're kind of working through the news, try to see if you can identify what this new narrative is going to be. They're all going to try to sing out of the same hymn book while each one remaining independent and trying to sound like they are their own person. At 10 a.m. this morning, we're going to have U.S. Michigan consumer sentiment, and as you can see, it's anticipated to be impactful. The consensus number this morning is 63. The previous was 63.5. So we'll have to see how it comes in. But that is very likely going to be the highest anticipated impact event for the day. So once we get past that, while these others, I'm not going to say they don't matter. A lot of them are they're a lot later than they're not going to bother you. And the rig count doesn't change very often big enough to make any impact. So we can see Japan had a really good night. They closed nearly 1% to the upside, while China had a bad night, closing more than 0.5% to the downside. There was news on Tesla that the Twitter CEO is going to step down. And so it got a little bit of love in the overnight, up more than 2%. Still looks pretty horrible in the bigger picture. To me, this was an opportunity for more firms to get out at a higher price, kind of a sell the rip. That was my first blush take on it, right? As soon as I seen that tweet that the Twitter CEO was going to step down and from Twitter, or he's not leaving it, right? Because he owns it, but he was going to delegate his responsibilities and get into a smaller role. The Tesla stock went up, and it was my first thought is, oh, I bet Tesla stock goes up. Well, if it was my first thought, then it was everybody else's first thought. And any of those big firms that are still holding on to a lot of this that want a chance to get out of it, they're going to use this for that opportunity. Really nice move on Amazon and Google yesterday too. All right, so here's China. We can see they closed inside day. They gapped up really strong, nearly gapped up to an inside day breakout, and then just gave it all back all day, closing near the lows of the day. Japan, on the other hand, finally followed through. Yeah, and someone mentioned the Tesla recall news this morning. You know, it didn't help either. So Japan had a really nice follow through, broke out of this May 9 candle that we had been inside, closing near the high of the day as well. So the other day I had mentioned this candle pattern, the bullish Haramni there. Only up here it would be a bearish Haramni, right? It'd be a bullish one if it was down here with a blue bar. So from up here with a red bar, it'd be a bearish Haramni. The thing is, when you get candle patterns like this, you can use them in either direction. And I had someone question me about the head and shoulders being in the wrong location, right? Inverse head and shoulders should not be at the top of a range. They're not continuation patterns, they're reversal patterns. And someone asked me to really dig deeper into that statement. So I did, by the way. And it's true, head and shoulders can be continuation patterns. So I misspoke. Let me say it another way. I don't want to use a head and shoulders as a continuation pattern. I think they have a better rate of success when you use them in their most popular form as reversals, which means when we get a candle pattern, not just head and shoulders, but any of them, they work better when you find them in their most common place, right? A bearish Haramni should be at the top of a range because we're expecting to go down with it. It's a bearish Haramni. But if you just consider the fact that it is a Haramni candle and you say discount the bearishness to it, there is your continuation. I don't think I would want to trade it that way, by the way. Just saying, you know, back here we had a bullish Haramni, and I mean, it didn't play out too well. Maybe for a few days it did, but so patterns work better when you find them where they're supposed to be. And when they do the opposite of what they're supposed to do, the books will tell you, yeah, it's okay. You know, it does that sometimes, but I wouldn't lean on that, right? Or just a second, guys. All right, sorry about that. It's interesting about Tesla raising its car prices too. I was reading articles on manufacturing, and Tesla has forced Ford to lower car prices twice this year already. And the only thing that really caught my attention on that bit is that Ford has a truck EV, and they didn't lower the price of that truck EV. They raised it 50%, 50%. I kind of felt that was a little greedy and extreme. Literally, I mean, think about if you run a company or you're selling services or products that you just randomly decide you're going to jack your prices up 50%. I think Ford really made a bad choice with that. Kind of the idea of nearly a monopoly concept, right? Well, if I'm the only one with an EV truck, I can price the EV truck at whatever price I want. You're going to buy it at that price or you're not going to get yourself a truck. Okay, that's only going to work for you until somebody else has got a truck. All right, the volume is really light this morning, implying that the market is not comfortable with some anticipated economic event today, right? Maybe it's the fact that it's a weekend, but that's not enough, right? I mean, if we were to go back and do Friday comparisons of accumulated volume, I doubt we would find less than 100 to be the average. So we have to look at this and realize that there's a couple of things telling us to be very cautious this morning. One is there's a market maker move. That should set alarm bells off as soon as you see it. And the second thing is that we have a complete and serious lack of participation this morning. That should set alarm bells off. We know we have that 10 a.m. econ consumer sentiment, and in the past that has been impactful. But more impactful than CPI? More impactful than PPI? Seems a little bit of a stretch, isn't it? Either way, I would approach trading this morning with absolute caution and wait for that 10 a.m. econ before doing any kind of 0-day trade or any swings for next week. You know, I'm a big fan of that myself, kind of building on the weekly expected move and putting on next week's butterflies and, you know, verticals and kind of just stacking the odds. I love to do that. But I want this first. I want this out of the way. I want it resolved. And I've found that that has saved my bacon more than once. And I like my bacon. So we don't need that anymore. It's done its job. Get it out of the way. We can thank Japan mostly for this run up this morning. It's not all Japan, but you know, a large part of it. And there's the spot gamma levels. SPX and ES on the right, and then SPY, QQQ, and then the NDX and the NQ. Right, at this point, but it should have that line there at saying what was the accumulated volume at 7:30. If it doesn't, you're probably using Thinkorswim's default cumulative volume instead of the one that I made that has the little line in it and the little label. Oh, no, mine is still actually reading 75 and the line is 74, 74.8. I don't know. All right, so this morning, we could make an argument that we have an MDP. We could. We opened up and ran right through it right at the open, and there's a little bit of an argument to be made about when it would apply, when it gets there, you know, all of that. The fact that we opened underneath it and ran through it, I'm going to go ahead and say it's not an MDP. But if you're the kind of trader who's always only using RTH data, then the fact that it might have hit it in the overnight wouldn't matter to you at all. You would only be looking at, have we hit the daily pivot in the RTH session? I'm going to go ahead and say we hit it, but this is one of those occasions where, you know, personal discretion might be the difference. I don't really think there's going to be a difference. It's such a negligible period at this point. And it really, when it comes to an MDP, it's one MDP. Okay. I mean, you know, I want to know it and I recognize it and I point it out when I see it, but two back-to-back MDPs, that's more valuable to me. So we'll see how we are on Monday. And if we have an MDP on Monday to also go with this, then I'll reconsider. But I'm going to say that we hit it. We are back above the weekly pivot nicely at this point. And even though we did expand really nice in the overnight hours, keep in mind, we're only up, we're not even up 0.5% this morning. So we've given it a lot back and we didn't run too far too fast because, I mean, we're sitting on VWAP. So as far as we did go, we didn't really go anywhere at this point. We're right back to the mean. It may feel bullish this morning. And the, you know, listening to Bloomberg, they were kind of chatty and exuberant, but it seemed a little false. And looking at the numbers, you know, especially with the light volume, I would say that the data point at 10 is going to be more of a tell for the rest of the day than anything else. So keep that bullish sentiment in check until at least 10. We are moving nicely through this air pocket up here. We shouldn't have any real issues if we can get above 4170. 4,200 should be a pretty clean shot to get through. The thing is, they've been front running 4,200, and we can see that, right? We can see where they've been running ahead of 4,200. So we're going to have an issue trying to get through that because we have to anticipate that they're not done. They're going to try to front run it again. And it's really shallow up there at 42. So instead of thinking about this iceberg or this ceiling in this case, and instead we want to focus on the front running, and then we want to consider the liquidity that's on the other side of the pivot. Since we haven't been there, we don't have a volume example here to really look at. We're just going to have to watch the dome if and when price does get up there. And, you know, unless this econ at 10 is got some fireworks underneath it, I don't think we're getting there this week. So it'll be something we'll have to think about next week. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. We were at the lows last, and we're still working our way towards the highs. So that's got to be, you know, our base expectation here. We really, if we were to, you know, think about a D shape, we've got one, but it's starting to unwind a little bit, right? We're getting some shading up there and some down here, but it is a classic D shape. If we spend a little more time here around this point of control, I think the D will perhaps begin to form a little cleaner and kind of fade away these edges. But until then, the VPOC is done. We took that off the table, but we got a new one from yesterday. So we'll just steal the line and move it down there. 41.40 and 3 ticks. You could just use 41.41. Honestly, it wouldn't matter, I promise. I'm a little OCD, so I'm trying to do it the same way every time, but it really won't matter. Just use 41.41. Why is it not duplicating like it's supposed to? You're broken. All right, we'll do it that way. Yeah, it's working now. Okay, whatever. So we got the VPOC 41.41. Remember that this is not support. It's not resistance, right? It's not even that kind of logic concept. It's the idea that that is where the bulk of the trading was done yesterday. More trading was done at that location than anywhere else. When we come back to that level, it's very likely that there's going to be a lot of activity again today at that location. You can think about, say, any trader who went long yesterday and now it's coming back down. They may decide, you know what, never mind, maybe I don't want this long after all. Or everybody who went short yesterday, and when it came back up to them and they didn't get out, are now considering the fact that if we come back down to that, they might want out. A million different reasons why all that volume is there, and a million different ways to anticipate that volume, that activity could occur again today at that level. Unhappy traders who no longer want their trade, unhappy traders who didn't get filled there, who now want to get filled. I don't really see this as an unfinished business zone, but it would be an area of concern. So you want to keep your eye on it. Watch how we approach that level and then how we negotiate through it. We're still holding above the 10-week. Still holding above that 10-week. So when we think about this wave, it's been a long, drawn out wave, as opposed to one of these more sharp, steep waves. We're nearly 1% above the 10-week. If we were to visualize that, the 10-week is at 41.18. It's way down here. So it's underneath yesterday's low. For a line in the sand, we would have to go all the way down, break yesterday's low, and then we would interact with the 10-week. That's how far away it is. But the 10-day, on the other hand, is at 41.42. Nearly 41.43, right? We just round up, 41.43. So if we make a break for it to the downside this morning, we'll hit the 10-day before we hit the RTH open of yesterday, but they're really close together. The RTH open is 41.41 and a half, and that 10-day is 41.43 and a tick. So really close together. All of this support is going to make it difficult to go down. And I'm not saying that we can't go down, especially with this hurry up and wait this morning that we've seen in the volume and that we can see in the market maker move. It's a huge warning. So just kind of keep that in mind. We are getting next week's weekly expected move box. It's not valid yet. It won't be valid until the market closes today. But just seeing it gives us a pretty good idea of what they are looking at for volume for next week, for volatility for next week. The easiest way to do this is just to draw a box on our current week and then grab that box and set it on the next week. I know it's not 100% spot on accurate, but the indicator's not closed anyways, right? So it's not locked, and that's not accurate. We're just trying to get a feel, right? And judging from what I'm looking at right here, the volatility for next week is the same as it was for this week, and so is the distance of the range. The only difference is we're so far gonna close this week higher than we closed last week by a negligible amount, and so the box is a little higher up. That's the only difference that I can see at this point, but that could absolutely change after we get the 10 a.m. data this morning. There is a little bit of old school technical analysis at this point that says if we haven't broken out and run, then it's hard to see that we're going to. But turn it around a little bit. If we haven't fallen down by now, it's very likely that we won't. I've heard it said both ways. One thing that gets my attention about this trash that we have here is this trash that we had here. And to a smaller point, the trash that we had here. And back here where it was much tighter. The thing is with these periods of quiet consolidation, well, they're not so quiet, right? Since the bear market began, these periods of consolidation are just violent chop fests where we go up and down randomly from day to day until we finally break out. Even the strat using that megaphone pattern, we're not even hitting the megaphone edges, right? I had to kind of put some shadow prints in there to define new edges. It's just a sloppy mess. Huge wicks on each side, big indecision candles, a whole lot of energy, a whole lot of running around, and absolutely no change from where we were at the end of March or, the beginning of April. After all that time. They say that 2023 is going to be the sideways year, the year of sideways. And I mean, looking at the indexes, I can see that, but not in the equities. So there's always more names that we could add to this, right? Maybe replacing Baba and Baidu with Snow and AMD, since they're in the fangs now. The NY Fang index is using Snow and AMD. So looking at all of this, Netflix, really nice run and expansion from 5.3 out. Snow has been really running since 5.3. It hasn't been so clean, right, as Netflix, but it's still been a really nice run. And AMD. AMD didn't close so good yesterday. Inside bar, gapped up, fell down. The bar before yesterday, this bar, that was a real telling bar right there. So we'll see how it plays out, but kind of keep that in mind, right? That we're kind of stalling out in some of these. If you look at Meta, that's not looking so hot. Microsoft, we had a very micro TRB setup in Microsoft, and the follow through was junk. And then, of course, yesterday with that graveyard doji. Apple, now with Apple, I got to say that looks like quiet consolidation before a next leg higher. That massive gap up from earnings is an island. If we gap back down, it'll be an island reversal. Otherwise, it's just quiet consolidation before continuation. And it's all resting on top of that trend line. So one play that you could do with Apple is that 5.5 candle. Just mark across that high. If we break out to the upside of that 5.5, double it, and that could be one of your price targets. You can do it with a box if you don't have a broker that has like that quant tool. Just draw the box, put the box on top of the next box. That's the simplest way to do it, depending on what tools you have. Otherwise, just use the quant lines and project it. 177.84 would be 100% of that candle. So if we break out, 50% is where a lot of analysts will tell you to go. Aim for that as your first target, and then 100% would be your second target. Otherwise, if we break down below the 5.5 candle, we'll look to at least get down to where the channel begins to close that gap, which would be 167.45. So Meta's up this morning, Netflix down, Nvidia down, Snow is down. We're not looking at FANGs up and running. And yet we had this nice expansion on the ES this morning. Even the NASDAQ is still up, not 0.5%, not even a quarter yet, but we still have some NASDAQ a little bit, but we don't have the FANG names. So next thing we can do now that we've looked at the FANGs is look at finance. Finance, oddly enough, looks more like Netflix, or not Netflix, look more like the NASDAQ than it does the ES this morning. But it was a little positive. Now it's a little weak underneath VWAP, not back down to where we closed, but certainly not as strong as it was earlier, and not as much flow either. And it makes sense with the ES having a market maker move and the light volume that everything else is going to stop and not get much volume either until we get that econ. One thing that really gets my attention this morning when it comes to these FANG names is being mildly gapped down or being mildly down. I consider that more bullish than bearish. I don't like a runaway market that gaps up and then gaps up and then gaps up and gaps up and gaps up every morning. One, it's unsustainable. Two, it's too much too fast. And I keep looking for it to kind of all unravel like building a house of cards. But when it gaps down and then rallies, I like that a lot better because a market should travel with a little bit of a give and take. And that's what we have this morning, say on Netflix. It's only down a few pennies, but it is down. And Nvidia down 50 cents, but I mean, that's a negligible amount. Snow is up. Well, let me rephrase that. It's such a wide bid ask that it's not up, right? It's maybe a little bit of both. First Solar, 193.3, 193.5 gets us part of the way through this gap here. Not all the way through the gap, but definitely in the channel and in the upper part of the channel, no less. $200.83 would close that gap. It's also a round number, obviously. Thanks, Captain Obvious. But those round numbers are psychological levels. It's got a market maker move of 1.16%, average daily range of 3.67. So you're looking at nearly a 5% possible move today on its own, even before we start considering what wild would look like. From the close, it's already up 5.7%. And this could easily double that. Kind of keep that in mind. Once these things really start to get attacked, and that's the way it's been lately, right? I mean, look at the absolute reward and punishment of some of the markets lately. The ones that run are running to the freaking moon, and the ones that are falling, they're falling all the way past every one of their levels that it should have stopped at. So seeing a market maker move of $2, I would easily double that. Don says, take the market maker move and take your expected move, add those two together, and then multiply it by 3. And that'll give you an idea of what kind of pain you could look at, right? If you're trying to consider like, well, how bad could it be? Multiply it by 3. Notice I said it was how you could gauge how much pain you could take, not how far do I think it could go to make money if I bought a call, right? That's two different concepts. Acquisition of Evolar, a leading European thin film company, for 38 million. And another 42 million in milestones. So looking at it on the weekly, I gotta say, I really didn't like that candle. And if we were looking at it on a daily, that would have just been a big gap up, and then we would have a big island and then a big, gap back down. So an island reversal, and now we're back up here again. It certainly doesn't look healthy. So there's your big gap up, there's your island reversal. It was back down here, and now we're back up here. So from one side of it, as long as we can stay above that 197 area, should be all right. And you could use this candle from March 1 as kind of your line in the sand, right? Just measure that. Oh, 196.9. So there you go. Notice the 1, 2, 3, 6. That's just kind of my own little thing tucked in there. It doesn't belong there at this point. We'll just go ahead and turn that off. Add a half. There we go. So if we continue this push to the upside, 206.71 is going to be an area of concern. And if you consider where that 206 is, it's basically the midpoint of all of this. got a lot of trash up there now that I've added a weekly quadrant line. But I think they would be helpful on the intraday. So 96, 200, 206, 211, 216, kind of roadmap, right? Lines in the sand. If we can get there and get above it, say close above it on a 15 or a 30 minute, then we'll target the next level, and then target the next level and the next level, and next level, all the way up. Just keep in mind that that kind of news is just like the news lately where we've seen a company get a nice strong pop to the upside when they lay off workers, or they put out some kind of statement that they are going to rebalance the way that they are spending their money. They're doing cost cutting initiatives, or somehow passing cost on to the consumer through their product. Any news like that has given markets a pop to the upside, and it doesn't last, right? It's like a one-day wonder. This is a little different because this is a much bigger pop than, oh, hey, we laid off 100,000 workers. So one thing that you have to think about is what its new earnings per share would be with these new acquisitions, right? I would say if you can do the math, figure out what they're absorbing, you can go that route, or you can just wait for one of the analysts to put out a new statement, see what it's worth, and that might give you a little bit of an idea of where it's headed. Market Edge updates pretty fast, especially if you have an account there. So maybe later in the morning, you could go into your fundamentals tab and click on Market Edge. It has a date right there, so you'll know if they upgrade it. Right now, it's still from the 5th, so it's not going to be very useful, but I would not be surprised at all if it changes today. And I would keep my eye out for any publication from an analyst who is going to at least attempt to give this a new forward guidance estimate. And that's all it would be, right? Is an estimate. And at this point, everything's just so, it just happened. You got to give it a little time. Options wise, a push like this could make these options really juicy. I'd sell the crap out of them. That's a technical term, but yeah, not today. All right, so Bitcoin down more than 1.75%. The KWEB China constituents also down more than 1.25%. Nat gas down more than 3/4. Bonds also down. It might have been easier just to name what wasn't down. Finance, biotech. Biotech's been an absolute monster. So looking at US dollar Japan, it's up this morning. Got a strong run to the upside. When this is going up, you got to expect gold, precious metals, miners are going to go down. You got crude trying to turn things around this morning. Had an inside day breakout. Strong consolidation, nice bottoming pattern, and it finally turned around and started heading back up. The only thing we can say right now, though, is that it's a recovered inside day breakout. It's certainly not making me feel, overly exuberant or bullish yet. If it can break through its own Globex high, that'd be a good start. Would target the RTH open and then start focusing on the low of the previous day, Wednesday. So maybe a RTH breakout and then work through these levels back here. And that's if we actually start getting bullish energy. So energy, instead of just crude, XLE, yeah, nice gap up. It didn't even bother with the whole breakdown and then rally back up thing. USO, this had the breakdown and the rally back up. It more closely resembles crude than the XLE energy ETF. But that's still really weak. And I'm not really seeing that as bullish at all. So looking at it on the daily, we have this really large TRB setup. But this is a gappy, ugly bugger, right? Better off looking at it on a weekly. And now things really start to come into focus. And the trend should be obvious, right? If you use that linear regression line, start at the last highest pivot or last highest leg and just pull it across. That kind of speaks for itself. Come back here to the lowest point of the chart and just drag it across. Or do the entire chart from one side to the other. These things normally are going to match or mirror. So if you get a 6% move on one side, it owes you a 6% move on the other side. It doesn't have to happen in that first leg either. It just owes you that eventually. That law, by the way, or that rule, works with oscillators as well. So RSI, stochastics, if it gives you a 5 print on the RSI, it owes you a 95 on the other side. Or conversely, if it gives you a 95, it owes you a 5. So we're looking at energy having the capacity at some point this year of getting this really big, like 150, 180 print. Imagine energy at 180 or oil at 180. Oh, that caused a ruckus. All right, so we got finance up just slightly. I mean, it's not looking really strong this morning. And energy up a little bit, not looking overly strong. We're talking reflation, right? The reflation space or the reflation names, XLE, XLF, XME, being mildly up very likely means we're just getting a small bounce on support before we roll over and continue lower. Econ, guys, it's that time. So everybody, enjoy your weekend. Be careful, be safe. Watch the clock today, and I will see you all next week.